Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. I'm joined today by a dear colleague and dear friend, Barrett Clayton. Barrett is the director of, Director of Secondary Markets at Lima One Capital. Very lofty title. You have,
That's right. Yeah, it sounds like I'm very important.
the more words in the title, the more important the person. So you beat me out on that today. I'm a simple boy. But Barrett, thank you for carving out time to chat with me. I'm going to pick your brain for the next little bit. And I think the best way to kick this off is just tell me about you. You like me, we were chatting about this the other day. Right now we're in June 2022. This is 7 years of me being at Lima One Capital. I started here 6 weeks after I graduated college, and you're not a terribly different story, right? Yeah. So talk to me
That's
about.
right. Yeah, I'm coming up 7 years in the company as well this fall. Joined in 2015. Really kind of my first real job out of college as well. Started in our rental 30 underwriting team, similar to you as well. I spent a little bit more time in there than you did, I think. But yeah, worked in rental 30 underwriting for a few years, then got the opportunity to move over to secondary markets, capital markets in 2017, and have been in this role ever since.
Yeah, and so much has happened for us as a company in that time, and our capital relationships, and
That's
just
right.
as a lot of waters to navigate, right? Like as I think about it now, like you and I young, right? Like I'm 29. How old are you?
29.
29.
Turn 30 in a few days.
There you go. You could be old man Barrett walking around here.
Yeah.
But you think about so much wildness has happened. Like you were in the capital markets world when COVID hit, and I know that was a roller coaster ride. And us at Lima One Capital being fully acquired by MFA, publicly traded REIT. Like you've so early in our careers to be able to be part of kind of these massive moving beasts is such a cool thing. And so all that to
Yeah,
say,
it has been. It's been a blessing for sure, and really cool to see. So, I, I've we've seen the company grow so much. When I started in capital markets, we were probably funding 20 million a month, and now we're upwards of 200 million up to 300 million a month, so it's been really really cool to see. So much has changed. I credit a lot to my mentor here, who had 40 years of experience, and really took me under his wing and helped me grow a lot and learn a lot of how to structure deals and different ways of financing our loans. And so it's been really cool.
yeah, shout out to Trez Moore. He's
Shout out Trez.
a beacon of the mortgage industry. I think he created the mortgage. So, all right, we will not continue down memory lane too much. Although I want to. Let's talk about how private lenders price. Right, so it's a constant. I'm on the sales side, and our inside sales retail team, our broker team, outside sales, like constantly pricing. That's a major factor in every single conversation, every single relationship. And at lenders there are similarities, but like it's such a mixed bag on how does a private lender price their product, right? It's not just one person saying, let's move it up, let's move it down. You have major macroeconomic factors that come into play all the way down to like our, corporate philosophy on credit risk and pricing. So if I asked you the question, how does a private lender price its loans? How do they come up with pricing? Explain it to me like I'm a 5-year-old. How would you take a stab at that from a very high level? I know it's a big question. Boil the ocean for me.
Yeah. So the first and foremost, how a private lender would price would totally be dictated on what their financing strategy is and their cost of capital, right? And so in our industry specifically, you've got, established lenders who have, been around for 10, 15 years. And then there's also still a lot of, mom and pop hard money guys who are, at 12, 13% interest rate for a fixed and flip loan, right? So
Mm-hmm.
um, it all really depends on your financing structure and your cost of capital and how you would price, and then also um, clearly the product type. Here at Lima One, I've been blessed to see all the different product types that we offer, right? So, value add multifamily loans different than mom and pop single asset rental loans. So those all get treated differently, but on a high level, like what's the private lender doing? Are they um, holding all their loans in cash, right? And just taking in that coupon, that's going to be very expensive. Are they're trading their loans to a third party, right? And if they're doing that, what's that third party doing with it? Are they financing it with warehouse lines? Are they securitizing, right? And then yeah, ultimately, like as a lender, what are you doing with those loans is going to be kind of how you price your book.
Yeah, and looking at, I think of it in three buckets: like selling whole loans, you're holding whole loans, or you're like securitization is a kind of another method to move stuff off your balance sheet.
Sure.
Of those three, like, is there just from like where you sit philosophically, not necessarily through the lens of your job, but just
Yeah.
philosophically, what are your thoughts on each of those and kind of pros, cons? Are there any kind of glaring big pros or cons with those?
Yeah. Yeah. I mean, if if you're funding, everything and holding it on balance sheet, if you're financing it or not, right? So if you're not, you can kind of do whatever you want from a credit standpoint, whatever you're comfortable with. If you're good going to 100% LTC, no appraisal, you can do that, right? And it's going to be expensive for you to hold it. If depending on the partners you work with, right? If you're whole loan trading, what are they doing with it, right? So if they're financing it with warehouse lines, that's great. You can get your coupons lower, but what are they going to allow, right? So like the more people have their hands in the cookie jar, right? Like the more restricted you kind of get from a credit standpoint. But in turn, that allows you to get typically a lot more competitive with your pricing. Um, you know, given the institutions that you may or may not be working with, right? All the way up into an S&P rated securitization that is going to have loads of constraints of what you can or cannot put in that, what you have to do versus what may or may not make a ton of sense from a operation standpoint, but check the box exercise. You're going to get great execution on that, depending on the market, of course. Right now, particularly um, with the interest rate environment, markets have been a little shakier, a little wavier than normal, right?
Yeah.
But high level. That's how I would answer that question.
Yeah. And then the last few years, really, you think leading up to COVID and through COVID, like securitization in this space has increased, I think, drastically. Is that fair?
Yes.
Yeah. And,
Yep.
and what's, I think the driver of that is more institutional level involvement in this space. But how does that, whenever a company like Lima One Capital or ABC Lending, like whenever a company dips their toe in the water of securitizing loans, and because you don't just go out and say, hey, we're going to securitize. If you're doing 20 million a month, you're like, hey, we're going to securitize $20 million worth of loans, right? Like these are
Right.
much larger tranches. It's like, what does that look like, and how over the last 12 months has that changed? I know that the market is very different, like fall of last year compared to as we sit in June of 2022. So, what's the evolution of that looked like as well?
Yeah. So we've been in post COVID artificially low interest rates for the past 2 years, which was really fun from a lender's perspective, and I think fun for everyone in our space, right? I know that our you know rental borrowers love being able to get those, mid to low fours on their portfolios, right? And that's awesome. But we haven't operated in a space like that or in a rate environment like that ever. And so, doing that for 2 years, it was great. We originated a lot of loans, and a lot of people did, right? And as we've seen the rate spike go up, there's a lot of loans out there that are lower coupons, and people need to do something with them, right? And so it's been really interesting to see kind of how things have changed, and kind of the pressure to do stuff with all of those loans. The inventory in our space in the securitization market's been now very favorable for bond buyers, right? Because there's all these loans out there that lenders need to do something with. And so yeah, it's gone from I'd say a lender's market more to I guess investors or bond buyers market for sure.
Yeah, and then another shift, like you talked about the rate environment, right? Like we had a couple years of, for investors, for lenders, like everybody, it was kind of shooting fish in a barrel. That low rate environment was just a positive for everybody. And yeah, one thing I keep reminding myself is like we are still at pretty close to historically low rates. And like what you mentioned,
That's right.
you and I both started as rental 30 underwriters. And I remember I was
Yep.
underwriting 30-year fixed debt for rental portfolios, 8.5, close to 9%. And
Yeah.
people were doing it. We were growing.
Oh
As
yeah.
a company. That department was exploding. People were absolutely happy to do
Yep.
that. Now we'll have people showing up, burning down the building if we send out that. But all that said, like we're still, it benefits everyone to keep that perspective of, yeah, rates have gone up, but comparatively still pretty low.
That's a really good point. And I think that's a really good thing to keep in mind for a real estate investor, right? So someone who's been more seasoned and has been investing in real estate for 10, 15 years, they're accustomed to finance. They've seen financing their rental portfolios at 7, 8%. They're used to that, right? And so, the environment that we have been in, I think that it was, sort of like crack for those guys, right? To get rental rates. I mean, it seemed like free money to them,
Yeah.
right? So what I would say to a newer real estate investor who's maybe only been doing that in this environment or the last 2 years, that we're still at a place where rates are historically low for our
Yeah.
space, and to maybe not be scared of that, or diving into to getting a 30-year mortgage now, because they've been used to seeing these crazy low rates, like, oh wow, like this money's really expensive. Well, it's really not, from the macro perspective of where our business and where our industry has been,
Yeah.
as a whole.
Yeah, super fair. And I'm thinking back to, it was like February, um, whenever rates started to move, like whenever we, as an industry, not us as a company, but like we as a mortgage industry, rates jumped, right, compared to where they were.
Right.
And they moved very quickly, insanely quickly, to where, nobody in this space or outside of the space was anticipating rate movement like that in such a short window. I don't think I hadn't heard any expectation about jumps like that. And you had, so talk a little bit about like what happened February, March, and now it's a little more of a stabilized movement, if that makes any sense.
Yeah.
But it was very, it was fast there for a minute. So what in the world happened, and why did you keep telling me that everything was getting more expensive, and us on the fourth floor had to go tell all the clients that, hey, money's getting more expensive? Barrett, why'd you do that to us?
Yeah. I mean, that's a great question, and I think if we knew the answer to that back in in January, we would have been able to make a lot of money. But so, we were all anticipating rates were going to increase, right? Everyone, the Fed had made that very, very, very clear. We were expecting it. I think everyone thought that it would happen in a smoother, way, or I guess slower, right? And, um, you know, Fed indicated they were going to move up rates, and I think that people started pricing in interest rate increases that haven't happened yet, and so it the market just got a little nervous, a little nervy, and we saw it spike, and we've seen it kind of stable out over the last 2 months, right? People have kind of gotten accustomed to where rates are at, which are similar to where they were 3 years ago. But with that being said, I think that initial wave was really tough, but these next couple of months, it should be a little bit smoother, is what I would anticipate. And if you were telling me to read the tea leaves, I would tell you that rates are going to continue to go up. The Fed's going to move interest rates a few more times this year, if I were to guess. And so, another reason from a real estate investor perspective to continue to get deals in now rather than later.
Yeah, sounds right. All right, one topic I want to jump on, and this will be our last one, and I'll let you get back to it, is the difference in fix and flip and rental pricing. Let's call it like short-term rehab, short-term construction loans versus long-term rental loans. We started, the industry had pricing movement upward on rental loans in February and March. But using the example that you and I both know at Lima One Capital, I don't think we touched short-term product rates until maybe the beginning of April. So why in the world is that? What are the differences there that make those two products operate so differently from a pricing standpoint?
Yeah, sure. So a few major components. I think the first one you sort of touched on is duration, right? So what I mean by that is the length of the loan. So your rental loan, your long term mortgage, right? It's going to be out there for potentially 30 years, right? And your fix and flip loan, short term, you're from a lender's perspective, you're hoping that you'll hold that for 8 to 12 months, right? And have the borrower be successful and get out of that, right? And so long-term rates moved a lot quicker than short-term rates. And so the spread between the 2-year and 10-year treasury got pretty flat there. And so that's why we were, kind of forced to move those rates quicker. Holistically, the differences as well, just kind of like keep in mind, right? Your credit profile between those two are pretty different, right? On kind of the risk you're willing to take. Typically, those fix and flip loans are priced a little higher than the rental loans, because some of that exists, right? There's some unknown with that project versus, cash flowing, performing rental property is, a relatively safe asset, especially as we mature as an industry and kind of seen that come to fruition, which, is why, we've seen the securitization market, blow up in rental 30 because, and by blow up, I really just mean like grow so much because the asset is one of the strongest performing assets that an investor can own and has been very safe and performed well.
Yeah, that makes sense. Barrett, you're a busy man. I'm going to let you get back to it. I can't thank you enough for joining. This was fun. It was a good crash course in high level pricing from a private lender standpoint. We dove into some examples wealth of knowledge. We're going to have you back here again, and we're going to hold you to the concept that it's going to be smooth sailing from here on out. Sure, rates are going to go up, but smooth sailing. I finally got you on video and audio recorded.
I don't think I don't know as exactly smooth sailing, but hopefully it won't be as quick. The rate increases won't be as spiky as they were.
You can't
earlier,
walk it back now. Sorry, it's already recorded. But no,
yeah.
Thanks again, Barrett. I really appreciate you sitting down with me. Cool.
Yeah, no problem.
Thanks everybody for listening. Take care.